So the next session, again, we are continuing on the open banking discussion. Our featured guest, as I mentioned earlier, is Steve Smith. So Steve was the CEO and co-founder of Finicity, which is now a Mastercard company. So his new title, which is not in the booklet, he is now Chief Engagement Officer for Global Open Banking for Mastercard. And so that's his new title. And if you don't know Finicity, it was a large data aggregator with open banking platform. And it also did partner with the GSEs to provide asset and income verification to expedite the mortgage origination. So I think they have contributed significantly, and also it's great to hear directly from Steve today. Dan Quan is going to moderate this session. Dan, to me, has been a real expert. I learn so much from him every time I talk. So he is now running the Fintech VC and a Fintech consulting firm, and also served as a senior advisor at McKinsey. Prior to that, Dan was with the CFPB and working directly, closely with Richard Cordray, the first CFPB director at that time. He was running the Project Catalyst, which was the innovation office, basically, at that time. So just a little bit about the format of this session. So we're going to start with Steve's prepared remark. And then we have two panelists, as you see, Rob Morgan from the American Bankers Association and Bob Pivoris from Intuit. So both Bob and Rob will speak briefly, and then Dan will moderate a deep dive discussion around open banking. There will be time for questions from the audience. So again, please use your chat box to submit your questions. I think, yep, go ahead.
Thanks, Julupa. I also want to thank the Federal Reserve Bank of Philadelphia for this opportunity. I've spent the last 30 years working within the technology industry. And in that time, there's been remarkable technological innovation. From the internet to mobility to cloud computing, we've experienced massive advancements impacting virtually every industry. While we've all experienced many benefits from this digital wave, one thing that has stood out like a sore thumb when it comes to data and applied analytics, individuals, families, and small to mid-sized businesses haven't reaped the same benefits as have large enterprises or technology companies. As a matter of fact, at times, it seems just about everyone is benefiting from our data except for us. One of the key reasons has been the technology was too expensive, or the ability to collect and analyze the data has been exponentially difficult with massive manual interaction and time required. This is where the advent of open banking and open finance is flipping the data experience. When we talk about how consumer permission data is democratizing personal finance, it's best expressed in a short story about a new fintech startup, Tomo Credit. Christy Kim, the founder of Tomo Credit, was one of 62 million Americans out there with a thin credit profile. A subset of this, 26 million Americans, are credit invisibles. And Christy found herself stuck in this massive invisible group of Americans. She came here as a student from South Korea. She worked hard. And in 2011, she graduated from college. She got a great job at a San Francisco investment banking firm. She had a good income. It was enough money to finance a car and rent an apartment, but she couldn't do either. With no credit history, she was locked out of the competitive San Francisco apartment rental market. Eventually, she found a landlord who made an exception and took her on as a renter, but she had to pay 6 months rent up front. Such a demand would quickly eliminate most renters. When she shopped at dealerships to purchase a car, she couldn't get a loan. She offered to bring bank statements, pay stubs, anything the dealership could possibly need to grant her a loan. But the answer was a hard no. No FICO, no car. She had to find a car she could buy with cash. After all this frustration, she stayed credit invisible. This is the catch-22 for millions of Americans. They can't get any credit because they don't have any credit. Research indicates that thin credit and credit invisible status falls hardest on minorities and new Americans. Christy saw an opportunity to help these underserved people. She started Tomo Credit, a credit card for thin credit consumers who need to establish a history of responsible borrowing. She partnered with Finicity to power her company using open banking. Instead of relying on traditional FICO scores to qualify, her applicants grant permission to access their bank account data where their financial fitness is easily demonstratable. It gives a real-time, accurate picture of their cash flows, and they can readily get approved for a no-fee credit card. They're welcomed into the financial system, not locked out on a technicality. Christie's company has pre-approved over 300,000 consumers, and she expects 500,000 cards to be issued just this year. That's hundreds of thousands of previously underserved people who now fully participate in the benefits of our financial system. This is just one of the empowering solutions that open banking can offer to the market using consumer permission data access. Tools for credit decisioning, payments, financial management, and access to capital are becoming smarter and more inclusive than ever before. Secure consumer permission data access is the fuel for these new financial services that empower consumers. So many fintechs, just like Tomo Credit, are out there helping people and fostering positive market innovation. Imagine a world without peer-to-peer payment apps like Venmo, which moved over $58 billion in payments last year, or high-volume home lenders like Rocket Mortgage, which significantly cut time off the lengthy home purchase and refinance process by going digital. Every fiscal quarter, millions of people are adopting these apps and platforms because they provide a low-fee service that makes their lives easier. If we didn't have AI-assisted tax prep software like TurboTax, millions of people would still be navigating the complex web of tax filing and mailing and paper filings. With the increased specificity that consumer permission data access allows, fintechs and financial institutions can now offer more specialized financial products and offer better financial insights than ever before. In the past, consumers and small businesses had fewer borrowing options to choose from. Now, with open banking and permission data, the diversity of lending mirrors the evolving ways that consumers make and manage their money. From the seasonal cash flow swings of a small business to the uneven pay of gig workers to everyday W-2 employees. The market is able to provide innovative and competitive solutions because innovators have access to real-time data and smart analytics. As a result, more people are participating in the mainstream financial services marketplace and enhancing their financial well-being. So with all of this positive movement, why am I here? These apps and services were born from a series of technological innovations referred to as open banking. It allows account holders, consumers, small businesses, and others to permission the use of their data for a particular financial service that provides specific benefits to them. The legacy technology for open banking is commonly referred to as screen scraping. This technology has proven to be extremely beneficial in allowing individuals, families, and organizations to benefit from controlling and using their financial data. As an industry, we are moving away from screen scraping to direct APIs for consumer permission data sharing. It removes credential sharing from the market and minimizes risk to consumers. Although most financial institutions or companies in the financial industry believe direct API access is superior and are moving toward this technology implementation, we don't want to go backwards. We don't want to lose ground in innovation by not allowing consumers to have continued access to their financial data. Open banking is a technological shift that is still very much in its early innings. As it emerges and matures, federal policymakers play a meaningful role in the direction and pace of this transformation. Providing clarity on important guardrails, including consumer data rights, data protection expectations, and data privacy requirements, will help shape a more secure, diverse, and inclusive financial market. As we transition technologies and enable more seamless digital experiences, we as an industry and regulatory bodies must ensure that consumers have data continuity. Currently, I am able to use my bank statements, online banking tools, and even paper checks to access my financial data. It's data that I've used widely for my entire financial life and to get financial services to date. Now, all of that data needs to follow me into the digital data realm. In other words, open banking and open finance. Data continuity ensures consumers and small and mid-sized businesses can access and use data they've always used in the past. An additional benefit is data shared through open banking is dramatically more secure than in the past, where we would print, mail, or email bank statements and sensitive financial documents, or even hand over a paper check at a retail cash register. For consumers and small and mid-sized businesses, continued access to their data and the right to share it with financial institutions or fintechs will be transformational. The move to APIs is absolutely the right move. We fully support the move away from screen scraping and credential-based access to the direct API model, but without rushing the process. If we could implement the API transition across the board immediately, we would and should. However, we can't move faster than the market is prepared to move without harm to consumers or even smaller financial institutions. A phased adoption of API technology ensures the most productive and inclusive outcome. We risk overburdening thousands of small credit unions and community banks that simply don't have the technology budget if we make this transition too quickly. As regulators, your support of the industry standard-setting efforts around API adoption is critical for success. Regulators' insights will be crucial in defining the guardrails that will keep us all moving in the right direction. Clearly, data access and control is paramount. At the same time, consumer data protection is a must throughout the access and sharing process. The API model layers bank-level encrypted security protocols on top of speed and convenience. The current manual methods of data collection, like email scans and paper, are all highly vulnerable to fraudsters. Safeguarding the data is foundational to accelerating innovation while protecting consumers. The industry has taken this very seriously and has applied market-leading technologies to do so. In many respects, data privacy is about transparency and permissioning. With clear transparency, consumers will know where, how, and for what purposes their data is being used. This means data should not be shared across or among organizations without offering consumers control through meaningful direct permissioning. At the same time, we cannot make the permissioning process so overly cumbersome that it acts as yet another barrier to consumer financial success. Putting consumers in control and in the know in the right way enhances privacy and enables financial inclusion through innovation. This is an inflection point. The successes of many new financial innovations demonstrate the value consumers see in using apps and services that consumer permission data has made possible. To keep the momentum of innovation going, all of us within the data sharing ecosystem can be a force to empower and protect consumers. Access to permissioned data has spurred innovation in financial apps and services. It's allowing more consumers to participate in the mainstream financial system. Working together, we can empower the world of consumer and small and mid-sized business finance. We can protect them. We can enhance their well-being by continuing to allow them to use their data to their advantage. I again want to express that we fully support a phased transition from screen scraping to API access as the industry standard. At the same time, I'd like to reiterate that consumer data rights must start and end with an individual's ability to access, use, and benefit from the financial data they've long relied on. They should be able to access it in a format in which they can permission it for use with financial services and app providers of their choosing. This, along with transparency, privacy, and security, will truly empower consumers and small and mid-sized businesses. It is critical to safeguard the continuity of these existing data rights allowing more equitable access to the financial services industry and to drive positive innovation. Otherwise, the great progress we've made so far will fade. Thanks for your time, and I really look forward to your thoughts and questions.
Thank you, Steve. That's a very nice speech. Next, I would like to introduce two panelists. Both are Bobs. We have Bob Pivoris, Public Policy Issue Manager with Intuit, and Rob Morgan, Senior Vice President, Office of Innovation, American Bankers Association. Both Bobs will each provide a short commentary to Steve's speech. After that, we will dive into a Q&A. Bob P., would you like to go first?
All right, thank you, Dan. And yeah, apologies for any inferred office space jokes as you all listen to the two Bobs for the next few minutes. But hello and good afternoon. First, I want to thank the conference organizers for the opportunity to talk about open banking today. I want to thank Steve for his opening remarks and all of you for joining us. For decades, Intuit has been on the forefront of enabling customers to import their financial data into our products. Today, our products allow customers to connect their bank accounts to see a full picture of their financial life or their business in a way that takes less effort and is less error-prone than manually entering that financial data. We believe that consumers and small businesses should have control over their financial data and decide who can access it on their behalf and for what purposes. Open banking allows consumers and small businesses to do that by authorizing third-party applications to access their financial information on their behalf, yet establishing guardrails and ensure these third parties adequately protect this information and only use it for the intended purposes that were consented to. We support efforts by the government to establish an open banking framework, including the CFPB's actions to define a rule for Section 1033 of Dodd-Frank. We believe that any open banking effort first needs to prioritize benefit to the consumer and small business and ensure that their data is properly protected and only used as intended and as they consent to. We also believe that an open banking framework should be designed in a manner that allows the financial services industry to continue innovating and provide clarity where existing regulatory guidance may be outdated or not clear. Last, when it comes to standards, we believe that industry is in the best position to determine the appropriate technical standard for sharing financial data. And to the extent possible, open banking should defer to industry and existing standards in lieu of providing new or prescriptive technical requirements. Now, I want to share support for Steve's comments regarding the industry's desire to ultimately access bank data via API-based. I also want to reinforce his point that screen scraping should continue to be allowed until banks are able to provide API-based access. We must ensure that consumers and small businesses are not put at a disadvantage because they can't use some of these new and innovative financial tools and services that rely on access to their financial information. We also agree with Steve that data access, control, and privacy is paramount to an open banking framework. Consumers and small businesses must provide consent on what data of theirs is being shared, who it is being shared with, and for what purposes. Further, they should be able to review and easily revoke those consents when they wish to do so. We believe that permissions need to be managed in a simple and easy to use manner so that the account holder is fully informed and in control of their financial data. If not, we potentially could see a cumbersome consent framework that prevents account holders from sharing their data, or worse, not really know what data they're sharing or for what purposes. So now let me turn it over to my partner, Rob, and let him share his thoughts. Thank you again for the opportunity to talk today, and I look forward to responding to the questions.
Great. Thanks, Bob. And thank you, Steve, Dan, and to the Philadelphia Fed for hosting this discussion. Dan, I know you were hoping as sort of the token banker on the panel, I'd push back on a lot of what's been said, but unfortunately, I think I agree with most of what the other panelists have said here. I think this is a really timely discussion, clearly a really important market in terms of getting consumers innovative financial services. And from our perspective, the banking industry shares a lot of these views. So you're going to hear me echo a lot of what Steve and Bob said here. And we share both of your optimism about fintech. We think responsible innovation in banking has the potential to bring more inclusive, affordable, and relevant financial services to customers. Banks are eager to adopt this new tech themselves and partner with fintechs to offer their customers the latest experiences. This is a big part of my job at ABA, is helping our banks identify new and established fintech firms to work with. And there's clearly customer demand for these products, both from banks, but also to participate in the broader ecosystem, which requires this sort of data sharing. And this is why banks are fully supportive of their customers' ability to share financial data, so long as it's done in a way that maintains all of those critical consumer protections both Steve and Bob mentioned. And banks are, for their part, working hard to help implement new technologies like APIs to facilitate the secure transfer of this data and to empower their customers. At the same time, we've heard a lot about how to do this right, but there are real risks when financial data isn't treated appropriately and if it isn't done right. Banking data is incredibly sensitive. It's among the most sensitive data that a consumer has, and this is why it was afforded special protections by Congress in Gramm-Leach-Bliley. And banks, for their role, are trusted custodians of their customers' most sensitive data. Morning Consult data shows that banks are far and away the most trusted providers in terms of protecting sensitive data. 49% of consumers trust their banks the most. The next category is healthcare providers, and non-bank financial service providers are just trusted by about 12% of consumers. This is why we see routinely consumers turn to their bank first to make things right when there are things like data breaches at retailers. They know that banks will make them whole, that banks will sort of maintain that trust. And this is why banks are in a trusted position here. At the same time, that Morning Consult data shows that U.S. consumers are among the most concerned globally about data sharing, increased sharing leading to fraud. The majority of consumers believe that increased sharing will lead to more fraud, which again, I think is why the challenge for us today is to find a way to facilitate this data sharing, moving to new technologies as quickly as we can as an industry to give consumers the ability to enjoy the benefits of sharing their financial data while minimizing some of the risks that they are exposed to. Fortunately, we've seen a lot of progress on this front. Dan, I think the CFPB took the right approach while you were there under Director Cordray in 2017. When it issued a set of principles that have served as a really flexible bedrock for strong industry progress. We heard Greg Baer earlier talk about the progress that's been made with API standards like FDX, the work that Akoya is doing to create a network that allows more small institutions to participate here. And as we look forward, we're really hopeful that the CFPB will look to build on these principles and support this industry-driven progress that we think is already giving consumers better, safer abilities to share their financial data. And I think, in terms of that, we have a couple of areas we think they can help promote that access. But Bob, I agree with your comment that we should look not towards prescriptive standards in how we do that, but providing clarity that can help the market develop and empower sort of the solutions that we as an industry have come together to build. And with that, I could go on for days, but I think it makes sense to get into the questions.
Great. Thank you, both Bobs. So honestly, there's so much agreement here, so which makes my job not fun at all. So I want to stir the pot a little bit and to just maybe create a little bit of controversy here. So I think from the previous panel, Greg Baer, and he talked up about open banking, saying there's a lot of benefits. And in this panel, all three of you agree that to some degree that open banking, open finance promotes competition and facilitates financial inclusion. Especially, I think Christy Kim's story, Steve, you talked about was very impressive. So we also know that many people across the country and the policymakers in DC are as concerned about how our data is being used. The CFPB recently issued an order to compel 6 big techs to disclose how they use consumers' payments data. So the question to this panel is, how concerned are we, or should we be concerned at all, that open banking could lead to some misuse of our data or even stifle competition? And Rob, you want to go first?
Sure. Thanks, Dan. I think that's really an important question and highlights the tough line the CFPB has to walk here, right? In balancing how to give consumers the benefit of using their financial data. And I think we all agree on that there is a benefit to consumers in sharing this data. But there's clearly an acute awareness of how financial data can be misused. Again, this is among a consumer's most sensitive data. This is not pictures of what you had for dinner last night. It is details about your life savings and data points that can help move that money from one point to another. And more generally, I think what we saw in Greg Baer's conversation is an increased focus on the appropriate role of big tech in financial services. This was highlighted in the recent report in the President's Working Group on stablecoins, where it pointed to sort of the really big questions that are raised as these large companies move further into financial services. And clearly, it's sort of the CFPB action looking for information on how these companies are using financial services data shows that there's sort of an awareness and I think concern about that misuse. But what I think is interesting in this space is many of these firms want to get into banking not for sort of the banking revenue, right? And we see this, I think the business model in technology is very different from the business model in banking. In banking is basically a maturity transformation business. You take in short-term deposits, make long-term loans, but instead technology firms generally, I think more so at the large technology firms, is about data. How do you package, sell data? How do you leverage those insights to sell sort of other things that may be unrelated? And in many cases, financial data is the last frontier that these companies don't have. Google's whole business is selling ads based on what you might buy because of your search history. Imagine if they knew exactly where you were spending your money, how much you had to spend. Imagine how much Jeff Bezos would pay to know what's in your bank account today. And I think that raises a bunch of really tough questions about how that data is used. Imagine if you had different pricing, for example, based on how much an individual customer could afford, or sort of timing. Your paycheck hit yesterday. Here's an offer on that laptop you've been looking at that makes it just $10 less than is in your bank account. Forget that rent's due tomorrow. So I think this raises some really critical questions that the CFPB will have to consider as they look at the role going forward and manage access to this data.
And Bob, do you disagree? With Bob? Bob P. Sorry.
Yeah, no, sorry. I was looking for the unmute button. I don't disagree that the CFPB is going to have to address this. I mean, if we look today at what's going on, consumer awareness around privacy and their sensitivity around how firms are using their data is significantly on the rise, and that's a good thing. And as a result, we're seeing very low tolerance by consumers for applications and websites that misuse their data or misrepresent what they're collecting and how they're going to use that. And so I think as we see a change in that sentiment, by consumers, that's going to be a forcing function for some of these firms. At the same time, we're also seeing action by the government to establish that a company has an obligation to inform the consumer, their user, what data they're collecting and how they're going to use it, and obtaining their permission for doing so, whether it's upfront or subsequently, if those conditions are going to change. And when firms are not doing that, there are significant penalties issued, levied by the government. And I think as we see the CFPB look at rulemaking for 1033, I believe we're going to see similar requirements included within that rule. And so combined between, action by the government and just what the consumer, what the small businesses are expecting, I think these are going to be pretty large disincentives for any company to misuse customer data. And as we talked about in the past around stifling competition, I don't think it would. This is, intended to foster competition and at the end of the day, provide the best outcome for consumers and small businesses by empowering them to use the data that's in their best interest and to get the best possible outcome.
So, Steve, what do you think? So it looks like both Bobs mentioned consent, informed consent. Maybe that's a way to make sure consumers' data is not being misused or used for the purposes other than what was originally permissioned. And what's your take?
Well, my take is that technology solves most of these problems, and the appropriate application of technology with guardrails provided by the regulators is the right way to go about it. There is a balancing act, as both have said, and I think I think that we can step through that carefully. Permissioned access should come together with accountability for that access and through transparency. So the technology exists to accomplish all of that. And I think that it should be applied. I think back a couple of decades, online banking was just becoming a thing, right? And mobile banking wasn't yet a thing. And everybody received paper statements in the mail that included their account number, their mailing address, their full legal name, and all the financial transactions associated with the last month's information. And every account had to have a statement. And so if you had multiple accounts with a financial institution, you received multiple statements in the mail. And every time you pulled out your checkbook and you wrote a check, it included your name, it included your account number, it included the routing number, and still today that's used. And GLB was established during that time. And so banks had a requirement to ensure that the printers that were used to create the statements and mail them out were following certain protocols and practices, that whatever was being done with printing checks was done with the highest degree of security possible. And now we get into a world where, we're moving away from access to data in that way and moving to digital access. Technology exists. Standards organizations are pulling together standards to make this work. And there has to be this appropriate, walking the line between, proper permissioning, full transparency, and accountability that the regulatory framework, I think, a regulatory framework can help create. And if we do it correctly, then we won't stifle innovation, and we won't go backwards in the approach, but actually make the financial services industry thrive even more, because we move to this place where we have a full digital solution set.
Great. Let's move on to the next question. It's really about cybersecurity. So with open banking, we see data is no longer held by financial institutions. Now it goes out of the wall, and third parties permissioned by the consumers now have access to it. And last week we heard Robinhood reported a cyber attack. Thousands of their customers lost their email address and their names got exposed. And many banks, I believe, still today they cite cybersecurity and private risk for the reasons to withhold certain data from being shared with third parties. And some institutions also are trying to block screen scraping. So, Steve, the question to you is, how should we think about balancing the competing objectives of increasing data access, which supposedly will help, promote competition and facilitate financial inclusion, and at the same time protecting privacy and safeguarding security? What would be your recommendations to policymakers, not just the CFPB, but also other banking agencies?
I think, first of all, thanks, Dan. I think, first of all, you have to look at that and say, well, what are the rights that we're thinking about here, right? So the first right we're thinking about is access to my data. If we establish that as first and foremost, as a fundamental right and a fundamental need of consumers and small and medium-sized businesses, large businesses, the right to access your data, the need to access data, then I think the rest of the equation can flow from there. The question is then, what standards, policies, and technology should be adopted and used to safeguard that data once it's permissioned and accessed by the consumer? If you start with the other side and you say, let's protect the consumer data, at absolutely the top of the stack, then suddenly you're starting to adopt policies and procedures and solutions that likely restrict access to the data. And this is one of the things that we're seeing generally in an industry-led approach, throughout North America. It's without the full guardrails and the framework that can be established. We're putting other people in the decision-making process, and we're allowing those decision makers to determine what's best for the consumer. Is it best that we protect, with full strength all data as it relates to consumers, and in fact, by doing so, restrict access? Or is it best to make sure that we have full access and that we do all possible to adopt the right technologies, not only for our own institution and our own purposes, but we also work with those that we're negotiating data access agreements with to adopt those same type of best practices around data security and info security generally, permissioned access and transparency. And I just think that, as I talk to people in the industry, they tend to either stack up on one side of that equation or the other. And I believe that data access is absolutely paramount. And then we should drive all of the practices and solutions around ensuring that we maintain proper privacy and best-in-class info security.
Great. We actually just got a question come in, which I think is relevant to this question. So, question from the audience: where will consumers and the small businesses get help in case of data breaches in an open banking system? Maybe Rob, you want to go first?
Sure, I can give the quick answer, which is if history is any indicator, consumers typically go to the bank first. And Steve, I think that's probably why we see some of the two different approaches, right? If you are the one who is making consumers whole when things go wrong, you probably lean towards the security angle. If you are the one whose job is to facilitate the movement of that data, you probably lean towards the access angle. I might actually sort of come down in the middle and say that you can't really do one without the other, right? You can't start with access and then later think about security, but you also can't start with security before access. And in some ways, those two need to move hand in hand. I think there's a really good technological base for that today. And as we think about sort of the CFPB's path going forward here, I think we've heard from a number in the panel, and feel free to disagree with me, that support for some of those industry-driven initiatives is important, but that there's probably a role for CFPB to play here in helping give comfort to both sides. In our mind, I think there's four things that can be done there. The first is, and I think these will benefit both the willingness to share the data because the security piece is in place, and I think will help facilitate both. The first is making sure that banking data has the same protections, whether it sits in a bank or a non-bank. Right today, Graham Leach Bliley provides certain protections for banking data, but the implementation is different at banks and non-banks, right? Banks are subject to the agency's interpretation, while non-banks are subject to the FTC's safeguards rule, which lacks things like breach notification. So we need to make sure that those are on par. And the second is to make sure that those protections are being applied evenly. So Steve, you talked about sort of permission needing to come with accountability. Today, sort of FTC rules on non-banks are enforced through enforcement actions after something goes wrong, rather than what we see on the banking side, which is proactive supervision, right? Regulators in to make sure any gaps are being addressed before there's consumer harm done. So the second of those would be making sure they're applied evenly. The third we've talked a little bit about is making sure community banks have the tools to offer these new, safer API options to their customers. I don't think sort of extending the window is the right option there. I think working with the core providers to help ensure community banks have access, and I think we've seen some progress here, is really important. And then finally, I think at a point we can all agree on is removing barriers to adoption, right? We see certain regulatory requirements making it harder for banks and technology firms and aggregators to implement some of these. And happy to dive into that a little bit, but things like the OCC's FAQs, which would require banks to essentially treat a consumer authorized platform as a vendor of the bank when the bank has no relationship, it stifles banks' ability to implement some of those API solutions. So we think there are a number of sort of tweaks that the CFPB can make that can help facilitate that adoption and put sort of access on par with security and not one ahead of the other.
Great. So we got about 9 minutes left. We still have a number of questions I want to ask the panelists. So let's move on to the next one. Let's talk about international. So both Mastercard and Intuit are very active in Europe, in UK, Australia, and other countries, which have been adopting open banking. The US is considering its own open banking regulation, aka the 1033 rule, being considered by the CFPB. So, Bob, this question is for you. What sort of lessons can we learn from those experiences? Are there mistakes that other jurisdictions have made that we should be aware of and try to avoid?
Yeah, thanks. What I would say is, based on our experiences outside the US, I think it's safe to assume that we're going to see some of the initial requirements not deliver the expected outcome, or it's going to require additional clarification from the regulator, from the CFPB, due to how the market has interpreted the requirement. So it's going to be important for regulators to continue involving industry throughout the rulemaking process and collect feedback as open banking is being implemented to understand where additional engagement and guidance may be needed. As we look at, our experiences in other parts of the world, I'm going to share one example from Australia and how they implemented open banking. Originally, there was a requirement that once an account holder once an account holder disabled a third party's access to bank data, the third party was obligated to delete the data obtained from the bank or any data derived from that bank's data. The goal of the requirement was to help protect the account holder, ensure their data was not retained beyond what the customer authorized. However, once the rule was implemented, we found out that there were situations where an account holder, in fact, did not want their data deleted. For example, they may have been changing banks and they closed an older bank account. Until the requirement was recently changed a few months ago due to industry feedback, we actually had to delete their data once they disconnected a bank account, which actually was not what they wanted. And it had negative consequences as it affected their ability to review and leverage the historical financial data within our products. Another example, looking at the EU, was the EU has a requirement that account holders must reauthorize every 90 days a connected third party. And so the intent there, again, is to ensure that the consumer continues to authorize this third party to access data on their behalf. However, some of the banks in the EU interpreted the 90 days as the maximum time period that they had to reauthorize. And should their risk assessment determine that they do it sooner, that they could do that. And so we actually have banks today in the EU that require their customers to reauthorize a connected bank account every 24 hours. This is not an ideal customer experience. It's actually overly aggressive in terms of the risk, and it actually is inhibiting the customers from getting the benefits from those financial applications. And so it's really important, as we see the first wave of requirements come out, in the U.S. as part of a 1033 rule, that there is a process to collect feedback and evaluate: are we achieving the desired objectives? Or are there additional tweaks or additional guidance that's needed? Now, that said, while I just shared two examples of what we would not want to redo in the U.S., in our opinion, there are some examples where there are best practices in other parts that we may want to consider within the U.S. In the UK, for example, we see a requirement that address many banks' concerns around liability and security should there be some kind of data breach or issue. Simply, once an account holder permissions a third party to access their bank data, that third party assumes liability should the data they possess become misused or compromised. We, as a fintech company, we understand and share the bank's concerns regarding liability and believe that this is one example that might meet the needs of the participants within a U.S. system.
Great. And Steve, you have looked at open banking regimes in globally. So, what are your thoughts on the issues that Bob just mentioned?
Yeah, I think Bob's summary was really good on the points and a couple of great examples that we have seen. What I can say is that the innovation engine in the U.S. has been, really remarkable, and an industry-led approach has has allowed a number of those innovations to flourish that, quite frankly, have started here in the U.S. and are now being adopted in other places around the globe. In other places around the globe where it's been more of a very highly prescriptive, regulatory first approach, there's, you're going to make some decisions based on a lack of information as to how it might impact adoption, how it might impact actual use cases, or how it might impact actual flow of data. And so we've seen in those situations where regulation almost runs ahead of use cases, innovation, and adoption, because regulation moves at a relatively slow pace. Sometimes that can get in the way of industry adoption and momentum. And so it's hard to say, is one better than the other? In Europe, where we're seeing now much more broad-based implementation to the regulatory frameworks, we're seeing innovations, the innovation engine start to run at a much faster pace, and even some of the friction points that they've addressed, as Bob outlined, in Europe, that still exist in the U.S. in an open kind of industry kind of environment where we deal with these friction points every day in either bilateral agreements or the way we engage together with banks. Those have largely been removed, and now the innovation pace is running very fast. And so I still believe we're very much in the early innings, and it's difficult to draw really specific conclusions. But there are point-based areas where I think, here in the U.S., we can look at those examples and we can probably be more informed in the approach that we take from a regulatory framework perspective.
And Rob, you may have the last word. So regulatory-driven top-down approach, which is adopted by most of other jurisdictions, versus in the United States, we are sort of a ground-up and laissez-faire. Which approach do you think is going to be the winner in the next 5 to 10 years?
Yeah, I think that's a really good question, and as I think both panelists have talked through, there's a mix here, right? Clearly, the industry-driven approach in the U.S. has led to tremendous, very rapid progress. I think our view is that the CFPB should look to support that progress rather than replace it. We have a few ideas. I'm sure my other fellow panelists have a few ideas about exactly how the CFPB can facilitate that. But I think supporting that progress is really where regulators should focus at this point in terms of promoting a safe, responsible, open banking ecosystem.
All right, I got one question, the last question from the audience. This is a trick one. From the panelist's perspective, what mistakes have the regulators, CFPB, OCC, Fed, FDIC, etc., made? So be careful about your answer. You don't have to answer it if you don't feel comfortable, of course. Or maybe frame it the other way. What mistake they should try to avoid?
Well, I'll take an initial stab and just say, the U.S. has an interesting, regulatory framework where we have several regulators and some degree of overlap among key regulators, and so I would say generally it creates some complexity around, really creating an overall framework that needs to exist. And so I'm just going to speak in terms of the challenge. I think it's uniquely important that all of the key regulators in the financial services space be working together to understand, how they fit, how their regulatory framework should fit in together to do exactly what Rob talked about in terms of, hitting this thing down the middle, where we have great technology, we have great solutions in terms of security, secured access, and transparency and accountability, and that removes some of the friction we see in an industry-based approach today, but also continues to ensure full data access and ability to drive innovation in the industry. So that's, I know it's a challenge. There's a lot to it, and but I hope that all the regulatory bodies are working closely together.
And Rob and Bob? You'll agree?
Yeah, I would agree completely. I think Steve hit the nail on the head here. Coordination is critical. What happens at one agency can have sort of an opposite effect, right? If one agency is sort of discouraging sharing and the other is encouraging it, makes it really hard to find the middle and find the productive path forward and to walk that line that Steve talked about.
Yeah, I would echo that. And then just really harmonization, depending on the bank we're dealing with and their regulator, we may be doing the exact same thing for a consumer, but I've got different requirements. And so that makes it challenging to actually introduces risk into the process. And it confuses the consumer why they can do something with one company or one bank and not another. And so seeing harmonization, I think, is a big opportunity for us.
All right. With that concludes our panel discussion. I want to thank Steve and two Bobs for this great conversation, and also thank the Philadelphia Fed for hosting us. Julapa, back to you.
Very helpful insights. Thank you so much, Steve, Rob, Bob, and Dan.